We appreciate you joining us today. I want to welcome you into America's Retirement Headquarters, home of the Retirement Guys formula, and America's Medicare Associates with Nolan Baker, Scott Kirshner, Chaz Price, and myself. My name is Chris Swan. 419-794-3030. That's the phone number. How you reach out to the guys at America's Retirement Headquarters. 419-794-3030. Online at arhq.com. On today's show, is there a better way to protect retirement savings than your 401k? The clock's ticking on ways to save you from future taxes and why it's important to start on that estate plan as soon as possible. All this and more. But first, let me check in with the guys. Gentlemen, as always, glad to be with you. How are we doing this week?
Doing good. Looking forward to spring. Maybe nicer weather coming our way. I think it was last year about this time we were getting the boat ready. I know, Scott, I went over to Mom's barn and started to get some stuff out of the barn, getting the boat ready. So I'm looking forward to warmer weather and things getting a little bit nicer. How about you guys?
Yeah. Hopefully this is the last snowstorm for a while we get in March, but it seems like every winter, spring we get this. So
yeah, it has to go out. Spring's winter's going to go out. I heard that March was going to be the coldest month we've had in winter. So the good thing is it's almost we're halfway through, and it'll be over soon.
Mm-hmm.
There you go, being able to weather the storm, so to speak. And that's how a lot of people really feel it should be when it comes to their retirement plan. If I just keep my money in the market, I can weather the storm, I'll be okay. Is that okay when you're a 20-year-old? Sure. Is it the best strategy? Not necessarily. Is it okay when you are in retirement? No, almost certainly not. And so we're going to talk about things that are probably better than having that buy and hold, wait and see, and weather the storm approach as we jump into this week's show. If you have questions about things, again, the number 419-794-3030. So let's talk about this. The Fed is going to meet again next week, and it has already signaled yet another rise in interest rates. But how long is this going to go on? Analyst Adam Johnson had this to say on Fox Business.
My opinion is that the Fed is almost done raising rates. Fed fund futures say that the Fed's going to be done at about 5.25. We're at 4.75 right now. So we're within 2 or 3 more hikes of being done. And remember, stocks always look forward by 6 months, which means the stock market's already saying, okay, it's done.
So guys, do you agree with this? And if it is going to start coming down, should we hurry and take advantage of the current rates, those opportunities we've talked about before on fixed income investments before they start coming down? And then how do you feel about the additional rate hikes and how that could affect the market?
Yeah, so 2 great questions there is, how to take advantage of current fixed rates and also, what is our outlook a little bit when we're looking at the market and, ultimately determining how interest rates impact on the stock market's going to be. We do a lot of what is called independent portfolio analysis. I think now is just such a fantastic time that, anybody who's listening, if you haven't had an independent portfolio analysis, we can take all of your financial information, put it in our software, and give you a couple of ideas on how to optimize it. Last week, I had met with a couple, John and Mary, and what we did when we went through their independent portfolio analysis, we noticed that they had an older annuity, and that older annuity was paying them a 2% fixed rate is what they had. And, back when they purchased it, 2% was a fairly decent rate. But because of how high interest rates have gone today, we were able to get them into a different type of an annuity. And in this case, we put them into a fixed index annuity. That fixed index annuity gave them the ability to also have a bonus up front. So if they looked at it, they immediately were able to get a bonus deposited into their account. They were able to have a fixed rate that was significantly higher than what their older rate was. And then in addition to that, if they chose the index option, if the market does go back up, they're able to participate in some of those gains. Annuities, you want to look at how much time frame is and what the surrender charges are, what the financial strength of a company is. But in John and Mary's example, they were able to, leave the office automatically having a higher rate than what they had before. We also met with another couple, Bob and Sandy. And Bob and Sandy had a 1.5% fixed rate account. We were able to get them to reposition it into a 3-year fixed account at 4.95. Plus, they were able to use some of that money and able to purchase what we believe are some discounted prices in the stock market. So when we look at it, current interest rates are actually closer to long-term averages. I think, a lot of us feel like, oh my gosh, interest rates are so high. But if you look at, where the Federal Reserve long-term interest rate is, we're actually still pretty close to what the historical average is. The effective Fed fund rate as of now was 4.57 compared to a year ago when it was 0.08. So the Fed fund rate has gone up a lot, but the long-term average is 4.6. So we're not quite far off of that. And I guess before I maybe jump into things about what our outlook is on the market, any thoughts or feedback that you guys have regarding talking about the interest rates and how that impact will be on the stock market?
Yeah, I'll take that one. I think you bring up a good point, Nolan, about perspective. It all kind of depends on what perspective you're looking at the interest rates from. As a saver right now, it is a great opportunity, as you say, to lock in some fixed interest rates that we really haven't seen probably in the last 20 years, the majority of my career. We've been, mired in this low interest rate environment. But from a stock market perspective, rising interest rates are not good. And I guess to Adam Johnson's point, I would have agreed with him probably a week or so ago, but it just seems that it's so much, there's so much of a variable nature about interest rates and the central bank's role right now, whether or not they should continue to raise interest rates or stop. And I think that just involves so many different factors, which, inflation's one, the state of the economy. And so the length of time that the Fed is going to continue to decide to take rates up is going to vary quite a bit. But one thing that I think is important to note about this rate tightening period is that it's been done so quickly. Generally, I think interest rate hikes are implemented over a longer period of time. And then, you'll see the Fed kind of take a breather, if you will, and kind of see what the effect is of the increases that they've already done. And this is where I think modern portfolio or modern theory kind of diverges, is that this Fed has just been pedal to the metal. It's almost like a horse that has blinders on and it's just running and you can't stop it. And it seems like although the inflation numbers are coming back still high, most of the people, most of the pundits we read and listen to are thinking that the Fed has kind of overdone it a little bit, and we see the cause of that, or the result of that, is the disruptions, particularly in the banking sector. We saw, the Silicon Valley Bank default. That's not a good thing, and I think a lot of people could draw some correlations to the aggressive Fed policy. So still to be determined.
Well, you can absolutely see the results. I mean, last month, earlier this month in the month of March, what we saw is short-term pain. I mean, when Jerome Powell talked about, the need to raise rates again, the market sold off and had one of its worst weeks in months. I mean, it was down, depending upon what index you look at, 4, 5, 6, 8%. Some of the indexes just got crushed. And as you pointed out, some of those stocks that were more, impacted by those really had catastrophic events. And I would agree in the fact that they're aggressively raising rates, and so that is causing short-term pain within the market. I recently took my son on a cruise for his spring break, and had one of the fantastic father-son trips. And before he gets finished with college, it was a great opportunity. And they have this unlimited drink package on the cruise ship.
Right.
So, some people take it a little too far. It's like we watch some people, and cruise ships are great for watching people. And, somebody do a shot after a shot after a shot after a shot. And, I don't know whether you as our listeners have ever drank, but you've probably seen people who drank too much. It's like the Federal Reserve is drinking too much, too quick. They don't allow some of that to absorb into the system. And all of a sudden, if you drink too much too fast, we can see what drunk, dumb people do.
Yeah.
And almost like the government's drunk, dumb people making poor decisions that's not giving it time to work out in the economy. When you have, interest rates as high as they are with things like housing or credit cards or cars, we are going to see some time where it takes, that to settle into the economy. Somebody has a lease agreement or a couple of years left on that on their car, or if they have maybe a mortgage, or if they have things like a rental payment, it may take time before they see some of the impact. So we would like to see that, slow down a little bit so you can let that kind of settle into the market. One of the things that I was talking to another friend of mine who's in the mortgage business, and he said, one of the things is if you look at it, when things are really bad, it's when real estate agents start selling their Rolex watches at the jewelers. That's when looking back, it's a painful time. But what we do know is looking back every single time it pays off for the investor who's patient and buys when others are selling at deep discounts. So it could get worse overall in the market short term, but you've got to be looking at where you're going forward, looking for buying opportunities. So what I did is I did a little research, and I looked at the results of the stock market when rates were above 6%. Now, again, rates are not 6% now. They're talking about raising rates a couple more times, but it's happened 5 times since the 1970s, right? So as long as we've been born, that's 5 times that it's happened. 60% of the time, the market was positive in the year after the Federal Reserve rate started to go back down, and 80% of the time it was positive the year after the rate started to drop below 6%. So the odds are in favor for the long-term investor. So again, if you look at back to what you said, your perspective, the perspective that I would say as an investor right now is to look at today's opportunities to determine how can you get positioned to not only survive but thrive in this environment. You know, you've got higher interest rates are great opportunities for the fixed income market, for seniors and retirees looking for more predictable income. Those are opportunities. The volatility in the stock market creates great opportunities for long-term investors to take advantage of quality companies that have absolutely just been beaten up. And the way that you can do that is, again, take advantage of an independent portfolio analysis. So if you are do it yourself and you're saying, hey, Nolan, what do you guys think? What would be your opinion of how, we could change the portfolio to optimize it? That's what we do. If you're working with an advisor and maybe you haven't heard from them in the last year or two and you're like, man, I feel like I'm out here on the cruise ship all by myself and I don't have a captain and I don't know how to park this big barge, right? Call us. We'll give you an independent portfolio analysis. Or if maybe you're not working with an advisor at all, you're getting ready to retire in the next 5 years, that independent portfolio analysis, I would say, again, in all the years of doing it right now, we're able to find so many great opportunities. And again, for you being our listener, we're happy to get together with you and provide you that independent portfolio analysis.
It's complimentary to you. Just as a way of saying thank you guys for joining us here on America's Retirement Headquarters. 419-794-3030 is the phone number. It's 419-794-3030. You may think to yourself, I don't have time on my side to be a long-term investor. And that's not necessarily true because we're talking a 20, 30-year retirement. There are certainly parts of your retirement accounts where you can think like a younger investor. And then for the more immediate future, the money you're going to need in the next 5, 10 years, this is where taking advantage of these interest rates and looking at, guaranteed income products and things like that could really work in your favor too, to see how it all works together. Again, complimentary independent portfolio analysis, 419-794-3030, or go to the website, arhq.com.